Ladies and gentlemen, welcome back to the channel. My name is Julius and I'm watching the best videos of the trading industry, so you don't have to. Today we are watching the new rules of trading in 2026 from Brando Trades. Okay, so it seems like he wants to tell us how trading really changed and what works now in 2026. Let's get right into it. You guys leave a sub and a like real quick, and now let's enjoy the video together. Here we go.
Trading rules have changed going into 2026.
Let's make it a little louder here. Market rule changes for 2026.
And if you're still playing by the old playbook, the market is actively ripping your account apart.
Is that really true?
I know this because I've been trading for over 16 years. I started with $6,000 and I built an 8-figure portfolio, and I also run one of the largest options trading communities online. I've watched thousands of retail traders go through every market regime ever since the end of the global financial crisis. And what I'm seeing right now is that the traders who are actively making money in 2026, they simply understand the new rules. The ones who aren't are following a playbook the market's.
Okay, I'm excited to find out what those new rules are and if I'm following them like naturally or if I have to improve on something here.
Stopped rewarding 2 years ago, and they can't figure out why it's not working anymore. So in this video, I'm breaking down the new rules of trading in 2026, what actually changed, why it matters, and exactly how to position yourself to win in this regime. Section 1, the market got faster than you. Think about what a textbook setup used to look like 5 years ago. You'd pull up your chart, identify a level, watch the price approach it, see the reaction, and then enter. That whole process, from recognition to execution, it might take 15 to 20 minutes.
Okay.
You had time to breathe, time to think, and time to size right. Now, that same move resolves in 4 minutes, sometimes less. The setup
Is that true? Depends on the time frame, isn't it?
appears, it triggers, it runs, and then it's over. And you're sitting there wondering what just happened. This isn't bad luck, it's structural. There's 3 specific things that change the speed of the market permanently. Number 1 is 0-day options. They now dominate volume. 0DT options. These are contracts that expired the same day, and they now represent the majority of options activity in the market. What that means in practice is that moves that used to take 2 or 3 days to develop are now being priced, traded, and resolved within a single session. The market is pricing in urgency that didn't exist before. Intraday volatility that used to bleed out slowly now spikes and snaps back inside an hour.
So do I think that the markets are real different from a couple of years ago? At least in the future markets. I'm only trading futures, so I cannot talk about stocks. Should be correlated, I think. Not really. So I'm trading for about 6 years. I'd say in volatile times, the market is still as volatile as years ago, and in slower times, the market can still be really slow. The thing is that in the last couple of months, basically almost since the start of 2026, we got those volatile and insecure political phases. We really got no political stability in the world currently in the last few months. So therefore the markets are really volatile and react to every single thing there is happening in the world. So maybe therefore it might seem that the markets are unpredictable and really fast, but I can imagine that there will be slower times ahead, and then the market will be as usual.
Whole timeline compressed. Number 2 is retail flow. It became a real market force. Retail isn't noise anymore. When you and 10,000 other traders are all watching the same breakout level on the same ticker, you collectively move the market before you even realize it. Institutions aren't waiting for you to enter and then fading you. They're front running the setup because they know exactly where retail's positioned.
Yeah, the retail traders getting better and better. There are more of them than a couple of years ago, that's for sure. And they know like more or less the same stuff. They're waiting for the same stuff. So liquidity and volume is being pushed to certain levels, while in other levels, basically retail traders are not trading as a whole. So maybe he's right in that context, but I still think that hedge funds and the big institutions always move the market. You can't do anything against it.
Your stop location isn't a secret. Your entry trigger is not a secret either. The crowded trade is a predictable trade, and predictable liquidity gets taken. Number 3 is AI-driven execution. Compress the news to price window. So by the time you read a headline, an algo processed it, priced it in, and moved the stock. And by the time you see the candle, 3 systems already traded the event. You're not
true. The algos are getting better and better, but I think if you have a working system now, the chances are that you can keep that working system for many more years, because the algos are already trading a huge amount of all of the trading activity in the markets, and it's not gonna get a lot different from now. Okay, I think 90% of all of the trading is already algorithmic trading, so it won't get any higher. So if you can trade profitable with those algos in the market, then you will probably stay that way.
Trading the news, you're trading the aftermath of the news, and the aftermath is sometimes completely different setup than the event itself. And here's what all this looks like in your own trading. The setup triggers, you recognize it, you start building the position, you feel good about it, and then your stop hits in 4 minutes on a move that used to give you 20. That's not the market being broken. That's the market doing exactly what it always does, becomes more efficient. The old playbook didn't get worse. The playing field got faster and the playbook didn't update. So if the market is this fast now, what's actually left for a retail trader to win on? That's the question. And the answer changes everything about how you.
But it's also the problem is that we are searching for faster and faster trades, okay? Back in the day, a couple of years ago, if you heard of day trading for the first time, maybe your expectation was, okay, I'm going to open a trade and I'm going to close it at the end of the trade. I'm going to make money every day. But now traders are not even in the 15 or 10-minute chart. They're in the 1-minute chart. They're using tick charts. They're using 15-second charts, trying to catch a little scalp that just takes 10, 15, 20 seconds to hit either your stop loss or your take profit, okay? They're trading lower and lower time spans, lower and lower time frames. Everybody wants success now in the next few minutes and not in a couple of days, okay? So it's also our fault because of stuff like TikToks, endless scrolling. Our attention span is just not good enough anymore to hold trades for a longer period of time. We want to make the 100% on our $1,000 account like today, okay, in the next couple of minutes. So this is also a problem with us retailers, that we are favoring those faster markets.
Think about your edge. Section 2, the edge moved from setup to execution. Go search best day trading strategy right now and you'll get 10,000 videos, all of them teaching the same 5 setups: the breakout, the bull flag, the support bounce, the gap and go, the VWAP reclaim. Every retail trader watching these has seen these explanations hundreds of times from dozens of different creators with different indicators drawn on the same patterns. There is no proprietary setup left, none. The information is fully commoditized. It works and someone knows about it, it's on YouTube within a month. The concept of a secret strategy, it doesn't exist in 2026. That edge is gone. So
yeah, what is basically an edge? You do not need a secret strategy. The holy grail to trading is just positioning yourself with the momentum. And whatever your indication is that a momentum is starting to one direction, that is your strategy. And then basically just trading a position size that is really, really, really small compared to your account size. Or it doesn't need to be your trading account per se, but compared to the money that you are willing to trade, okay? It could also be on your personal bank account that you have a couple of thousand that you are willing to put into your trading. So it doesn't need to be the balance that you really have on your broker's account, but compared to the money that you are willing to use for trading. Trade a really, really small amount compared to that. And that's the holy grail, okay? I'm not the biggest advocate of saying, okay, you need to have a really good reward risk ratio from 1.5 to 1 and above. No, maybe your reward risk is below 1. Could also be very, very profitable, okay? So I'm not talking about that. I'm just talking about positioning yourself with the momentum, taking the advantage of the direction that the market is currently in. And the market is always in a direction, okay? Even if it's in a sideways direction currently, in the bigger picture, it's either going up or going down. So if you're in a position and your stop is relatively big enough, you will make money if you're in the right direction, okay? I think that's obvious. So that's just the holy grail, and your very, very small position size, so your mindset is strong enough to handle all of that, okay? And that's basically making money in trading. It can be so easy, okay? Of course, now the hardest, I'm talking way too much again. Of course, now the hard questions are, how big is your stop loss? Where to put the stop loss? Where to take the profit? That's the hardest question, and maybe being smart enough to understand, okay, in which direction is now the momentum? Are we going up or are we going down? All right, let's continue.
Here's a scenario I want you to actually sit with. 2 traders, same ticker, same level, same timing, same setup, perfectly identical entry signal. One ends the year up and one ends the year down significantly. The setup didn't decide that, the execution.
Again, we are talking about a year of trading, guys. Who even in today's markets, in today's life, has the discipline and has the patience to trade a system for a whole year without changing it? Almost nobody. If you're trading a system and 1 month is unprofitable, you say, oh, this system is not working for me. Okay, really trade a system for 1 year and then making a resume if you made money? Requires patience.
Did. How they sized relative to their actual conviction, not their feelings, their conviction. And whether they waited for the specific entry point or took what was close enough because they didn't want to miss it. How quickly they cut the trade told them it was wrong. Whether they had the discipline to walk away completely on days when the setup wasn't there versus manufacturing reasons to be in the market. None of that shows up on a chart, and that's exactly why traders who are obsessed with finding a better setup never
Those are Pokemon cards in the back. Okay, that's interesting.
actually find their setup because they're looking in the wrong place. The edge isn't in what you see, it's in what you do with what you see. If you've been grinding for years trying to find the right system, the right indicator, the right setup, and you still haven't found it, I'm telling you right now, it's not out there. Stop looking. The edge you've been hunting is in the mirror. It's in your execution, and that's actually good news because it means it's completely within your control. Section 3, fewer trades, more money. Early in my career, I was taking 10, 15 trades a day, and I thought I was learning. I thought reps were the whole game. I was reinforcing bad habits at scale. Now I might
That's true. If you're taking so many trades and you're making mistakes over and over again, you really are implementing those mistakes by those many trades, okay? You're really soaking it up so those mistakes become a part of you. And that's like really, really dangerous.
take 5 trades, maybe 10 in a week if the market's hot, and the account is dramatically larger. The math runs the complete opposite direction of what most beginners assume. And in 2026, this is more true than it has ever been. And here's why. When the market is fast and moves are sharp, there is no grace period for lower probability setups. In 2019, you could take a B grade setup and get away with it because the move was slow enough to give you time to adjust. That cushion is gone. Low probability trades in this regime get punished immediately and fully. The cost of being wrong has gone up, and the window for almost right has completely disappeared. Let me give you a picture that makes this concrete. Trader A takes 50 setups a week. Even with a 60% win rate, they're paying commissions on all 50 trades.
Well, depends on what brokerage you use. Probably yes. But there are some CFD brokers who charge no commission, but they will charge a spread.
They're eating slippage on all 50, and they're making emotional decisions across 50 different stress events spread across the week. Their discipline breaks down by Wednesday because they're already processed more decisions than the human brain handles cleanly. Trader B.
I really have to agree with Brando on this one. Okay, the emotional stress accumulates over many, many trades, okay? Do not forget that. That's a really good point that I'm hearing for the first time from a trading influencer whatsoever, trading educator. The emotional stress also depends on the number of trades you're gonna do, okay? So if you're following my advice and trade a really, really small position size, you can handle the stress. But nevertheless, it's accumulating over the many amounts of trades you're gonna do.
Takes 5 setups a week, same 60% win rate on paper, but their decisions are cleaner because they're not mentally depleted. They're sizing properly because they're not trying to make back Wednesday's losses by Friday. They're recovering fully between trades instead of spiraling. The same edge on paper, but completely different P&L by December. Your job in 2026 is not to find more trades, it's to ignore most of them. The setups that aren't quite there, the days when the tape is unclear, the trades where you're reaching a little, pass on all of it. Wait for the setup that fully matches your framework and then execute it cleanly. Some days the right number of trades is 0. Cash is a position, and protecting your account on a day when nothing is there is not a weakness, it's a skill. And
That's really good advice.
in this market, it might be the highest leverage skill you have. Section 4, size beats entry. Let me frame what's actually different right now. Retail traders today have access to options leverage, prop firm capital, futures contracts, and 0 DT options. The amount of risk you can put on with 3 clicks is multiples of what was possible 10 years ago. Most traders treat that as a feature. More leverage, more upside, more opportunity. It's a trap if you don't size for it. Here's a specific scenario. $10,000 account. You've identified a legitimate setup. Right entry, right level, high conviction. And you size at 30% of the account because you feel strongly about it. The trade goes
Okay, 30% of the account in one trade, guys. Whoever trades 30% in one trade and isn't like one of the best traders ever is just certainly a stupid trader who will blow up his account. Okay, guys, I'm talking not about 30% per trade. I'm talking about 0.3% per trade. Okay, big difference. Also on your emotional stress.
against you by 7%, and your account is now down 20% on a single position. 3 of those a month and the account is done, regardless of how many correct setups you identified along the way. That trader wasn't wrong about the market. They were wrong about the size.
Well, they also were wrong about the market. If your stop loss is hit, you were wrong about the market. Full stop.
Here's what good sizing actually looks like, and I want you to be concrete about this because size properly is advice everyone gives and nobody defines. Before you enter any trade, you define your stop, you define your max loss, and not...
Yeah, that's 101. That's so important, guys. Do that, really do that. And do not move the stop loss further away. Do not. Also, be careful with moving your stop loss closer to your entry. A lot of gurus teach you that it's a good thing. Immediately move the stop to break even. It can be good. It can be really, really making the edge, but be careful with it. A lot of times you move, if you touch your stop loss too early, I know that the opinions are differing, but I'm certain that the market wants to fish a lot of retail liquidity before continuing in the overall trending direction. If you are moving your stop loss too fast, you will be fished and then the market is taken off without you. And that per se is not the biggest problem because you got stopped out at break even, but the spiral it initiates is where you want to make that money back. And you can live with it because you knew, oh, actually I was right and I just got stopped out break even. I have to make that money back because I was right. That spiral that will lead to certain failure. Okay, so just be careful with your stop.
After you enter, not when it starts going against.
Sometimes it's easier to just accept that you were wrong in your anticipation than to actually be right but not profiting because you got stopped out at break even. That is a worse feeling.
You. It has to be before you touch the order. Then you calculate the maximum dollar amount you are willing to lose on the trade. Let's say it's 200 bucks. Then you size the position so that if the stop hits, you lose exactly 200 bucks. Not $400 because you sized up a little, not $600 because you averaged down.
And this is not working with futures, by the way. In futures, the lowest thing you can trade are micro futures, and you cannot change them so precise that you say, okay, now I'm just gonna risk $200 on this trade, because the stop needs to be where the stop needs to be and not where the balance is. Okay, if you say my stop needs to be here, why is a stop at a certain point? Because then your trading idea of the direction you want to trade now is not working. Okay, you say if my stop is getting hit, the trade direction went into another way than I anticipated. There your stop has to be. And then you can say, okay, I want to maybe just lose 200 bucks, but even one micro contract can be like whatever, 300 bucks. Okay, so in futures it's not that easy to calculate that. In CFDs, where you are able to really change the position size very precisely, it's better to do that, but also the calculation takes maybe 2 minutes. And if you're more or less a scalper, you do not have to those 2 minutes to calculate your position size, or you need to trade a higher time frame where you have those 2 minutes.
Exactly $200. You decide this before the trade, not during it. That process is the most concrete expression of discipline that exists in trading. You cannot think your way to discipline, you cannot motivate your way to it, but you can size your way to it. Because when the position size is right, a loss is just a loss.
That's what I was talking about from the beginning.
And it doesn't become a crisis.
That's the holy grail, by the way. And I'm not the best here. I have my problems as well trading this position size that is that small. Because even with one micro futures contract, your position size is actually too big for a $10,000 account. Okay.
It doesn't become a reason to revenge trade. It doesn't take you out of the game. And when losses are just losses, you stay in long enough for your edge to compound. The math only works if you're still in the game. Section 5.
Because if you listen to me, my calculator here, let's say some realistic example, which might already be a big amount of money for you, is like if you have a $20,000 trading account, or not trading account, but trading capital you want to use for your trading. And you say you just want to risk 0.1%. So 200 bucks. 200 bucks would be 1%. Okay, from $20,000. Now, 0.1% would just be $20. Risking $20 on a trade with a $20,000 account, you won't make any substantial amount of money. So this is why I'm talking about it's really, really hard to follow that. But now imagine yourself where you just lose $20 with your $20,000 trading capital. Do you care that much? I'm a person, I feel bad in a loss, no matter how big the position size is, because I just hate losing. And I want to be right in the market. I want my analysis to be right, so I hate it, even though it's just $2. But the mental, psychological stress, we all have to agree, with 20 bucks is not there. You do not have those really hard feelings that you have if you're losing, I don't know, $2,000 on your $20,000 account. even bigger, $10,000, blowing up half the account on a day. Happens. That's bigger stress than 20 bucks. So that's a holy grail.
Context beats the chart. Most retail traders are chart first, context second. They pull up a ticker, they look for a pattern, and decide if there's a trade. And in 2026, that order is going to cost you consistently. Let me define context concretely because it sounds abstract and I don't want it to. Context is three things. The most important thing is the macro picture. What is the Fed doing? What are rates doing? Whether the dollar is strengthening or breaking down, what inflation data just printed. This is the weather system the market's operating in. Ignoring it because you trade a single ticker is like ignoring a hurricane because you only care about your...
Okay, per se, it's good advice to keep all that in mind before you make a trading decision or analysis. But guys, let's also be real and realistic. If I want to trade the 1 minute chart, no, he's talking about completely different things here. He says like doing 5 trades a week, so probably he's not trading the 1 minute. But if I'm trading the 1 minute chart, I want maybe to hold my position for 5 minutes. Do I really need that fundamental analysis, what the Fed is doing in the last few months? Let's be realistic here, guys. I know it's good advice, but we won't do it and we won't need it in the 1 minute just for a trade that takes 5 minutes. I can also see the trend just in the chart.
Your neighborhood. The second thing is the index posture. What is SPX doing? Is it in a trend? Is it ranging? Is it showing signs of distribution? Is QQQ holding above a key structure or starting to crack? Is the broader market risk on or risk off right now? This is the current of the river. You can swim any direction you want, but you need to know which way the water is moving. The third is the leadership tape. Are the strongest names in the market acting strong? The mega caps in your sector are quietly rolling over while the index holds up on the back of a few names. That's information. Divergence in leadership is one of the earliest signals that the tape is changing. None of this lives in a single ticker chart. None of it. Here's a real scenario. Apple is sitting at a clean support level. The chart says buy. Textbook setup. You enter, but the broader index just broke a multi-week range to the downside. That tape is risk off. The strong but the broader index just broke a multi-week range to the downside.
Of course, yeah. Then the overall trend is short.
That tape is risk off. The strongest names in tech are quietly losing leadership, rolling over on lighter volume. Your Apple chart was right, the trade was still wrong because the chart was rolling enter, but the broader index just broke a multi-week range to the downside. That tape is risk off. The strongest names in tech are quietly losing leadership, rolling over on lighter volume. Your Apple chart was right, the trade was still wrong because the chart was answering a smaller question than the one you actually needed to answer. So inside Elite Options, my Discord, every single morning starts with market context before any individual ticker gets touched. And it's not because charts don't matter. It's because a chart read out of context in this macro regime will fool you constantly. The chart becomes a confirmation tool, not a decision tool. You use context to decide whether a trade makes sense, and then you use a chart to decide whether to take it. In 2018, in a low volatility, slow grinding bull market, you could trade a clean chart and be fine. The macro was a tailwind so consistent that it made chart reading enough. In 2026, the macro is a force. Sometimes
that's true, especially for higher time frames. Okay, the macro structure is more important. This is why I do not like trading bigger time frames, because then all of the political mess really plays a big role in your success, and I just want to skip that. I'm gonna be honest with you, I just want to skip that. I just have the risk that I'm into a small position and then, I don't know, there's a Trump tweet and the position runs against me and stops me out. That risk is always there, but I do not want to be in a long position and then something big in the war happens and I have to reassess all of the macro structure in the world before I try to enter a trade on the daily chart. That's not what I like to do.
It's a tailwind, sometimes it's a wall, and right now ignoring it makes every chart you read less reliable than it looks. Context first, chart second, every single time. Section 6, if the playbook is public, the playbook is gone. I want to be clear about something before I say this because I'm an educator, and this might sound like I'm undermining my own work. I'm not being cynical here, I'm being structural. Markets are adversarial by design. There is a buyer and a seller on every single trade, and someone is right and someone's wrong. When 10,000...
Sometimes both people are right. If you're buying a market at a specific point, I'd say this market is going higher now. If you buy here and someone is selling here, and I don't know that, let's say the market is continuing, you take your profit, but the seller is still into a currently paper losing position. You already went out of the market, you won. The market is now coming down and the seller is closing his position here. He also won.
Retail traders are all watching for the same breakout on the same ticker, sized similarly, with stops clustered in the same area below the level. They collectively become the most predictable pool of liquidity on the tape, not because someone is specifically targeting them, but because a public, repeatable, widely taught pattern is the easiest setup in the world to anticipate from the other side of the market. You felt this. Think about any famous setup from a popular trading channel 3 years ago. Track its performance now. You probably can't, because the setup quietly stopped working. The channel quietly moved to a new one, and a fresh batch of content got released with fresh testimonials. The cycle repeats, and it always will. Not because people are being dishonest, because that's literally how markets work. Every edge has a shelf life. The more public it becomes, the shorter that shelf life gets. This applies to everything I teach, including this video. Every framework has an expiration date, and the traders who survive across multiple market cycles aren't the ones who found the best playbook. They're the ones who learn the principles underneath the playbook, so when the structure shifts, they can rewrite their own rules before the market punishes them for the old ones. The traders who are losing right now aren't bad traders. They learned a playbook that worked, conditions it was built for. It genuinely worked. The conditions changed, and the playbook didn't. And nobody told them to update it because the people teaching it were still getting paid to teach it. Trading in 2020.
That's really good. So true what he's saying. So true.
26 is harder than it was in 2021. And it's not because the
This is why I'm just trading the momentum that the market is doing. The market is always going to into one direction. Maybe in a shorter time frame, maybe in a bigger time frame. But as long as you're on the right side, you're gonna make money. Doesn't matter which year it is. Doesn't matter what the gurus are teaching this year. All of that does not matter.
market's unfair. It's because it got more efficient. The public playbook got more saturated, and the window between this works and everyone knows this works got shorter. The traders keeping up are the ones who treat their own rules as a working draft, not a religion. Who can look at what's happening in their own account in the broader market and ask, is this framework still being rewarded? And if the answer is no, they update. They don't defend, they update. That adaptability alone, that willingness to rewrite your own rules before you're forced to, that's the actual trading rule in 2026. So here's what actually changed and what you need to do about it right now.
Okay, let's make a little summary.
The market got faster, so stop expecting the old window to hold. Adapt your timing. The edge moved to execution. Stop hunting for a secret setup that doesn't exist and start executing what you already know with precision. Fewer trades, more money. Your job is to ignore more setups, not find more of them. Size beats entry. Define your max loss before you enter. Size so that a loss is just a loss and let that math protect you. The context beats the chart. And know where the market is before you decide where the trade is. And if the playbook is public, the edge is already gone. So learn the principles behind the rules. Stay adaptive and treat your framework as your working draft. This isn't the easy version of this content.
Okay, this was a really good video. Immediately deserves a like. I'm already subscribed, as you should do to my channel. Subscribe down below, leave a like. Thank you for your support. This really helps a lot. If you enjoy my opinion on different trading videos. Thank you guys for watching. This was really great advice. Hopefully I could add some of my knowledge to this. So in theory, this should be a really good educational video at the end. Hopefully you enjoyed it. We're gonna see us next episode. Take care of yourself, guys. Good luck with trading this week. Have a nice rest of the day. Bye bye.